Studio is Kevin Lings from Stanlib. Kevin, thank you so much for your time. Everyone's waiting to hear what the Fed has to say. We're thinking
it's a
maybe
big event.
Quantitative easing, alluding to more stimulus, non-farm payrolls under the spotlight. What do you say?
Look, I think unfortunately the data out of the US in the last while hasn't been great. I mean, I thought the last employment number wasn't good. And even the rest of the data is just not convincing in terms of the recovery, and that's the problem. Every data you look at, none of it's suggesting that the recovery is taking shape the way the Fed would have liked. So everybody accepts the Fed's on hold in terms of rates, but it's the detail on the statement. I expect that they'll continue with keeping rates at these levels for, I use the phrase, an extended period of time. And whenever you see that, you interpret it as an economist for the next 6 months. So I think that phrase will still be there. What's going to be important is, does he downgrade his basic overall view on the economy? And that's creating uneasiness in the markets at the moment. The general expectation is that he will. He'll come out more cautious on the growth rate, which suggests that underneath it, in terms of the Fed's model, he's had to revise down his growth expectations. And if that comes through as a statement, the market will see that as negative. It's certainly pricing part of that type of view in. And I think it would be fair, because the data we've had in the last while hasn't been great. He can't really point to even one data point to say, look, there, it's more convincing. Everything's a little bit soft. So unfortunately, it's quite a big announcement in terms of the detail.
Okay, well, taking a look at some other news out here in South Africa, we had Finance Minister Pravin Gordhan talking about the central bank and the fact that there shouldn't be shareholder interference. You had the ANC coming out and saying that the rand is far too strong in comparison to our other trading partners. What is your view on all the comments that were made today?
Look, I think that it's a tough game in the sense that the rand is too strong for the economy. It's in my mind, it's stronger than fair value. Fair value would be around 8 rand 20 to the dollar. So it is strong. The point is, and the point with all of this stuff is, what do we do about it? There's no doubt that the rand has hurt us in terms of our export capability. And you can hear that if you're chatting to Mondi. You can hear that they've had to make some business decisions based on what the rand is doing, and many other companies have done the same thing. How do you respond to it as a central bank? If you start to target the rand, it's a very dangerous exercise, and I don't believe the central bank would want to do that as a purposeful policy. I think there's more they can do to interfere in the market, and there are a lot of ongoing discussions around that. So perhaps we'll see more action from the Reserve Bank in terms of trying to maybe weaken the rand a little bit. But for them to specifically target the rand or target a particular number is a very, very dangerous game, because the rand is just not that stable. You can't take the rand from current levels to 8 rand and think it's just going to suddenly magically stop at 8 rand. And we don't have enough money to support it at 8 rand if it comes under pressure. So I don't know there's a whole lot that can in reality be done. Maybe at the margin the Reserve Bank could do a bit more, maybe at the margin the government could do a bit more. But it's a consequence of where South Africa fits into the global environment.
All right, we're turning our attention now to small and mid caps. Sean Stockert, Head of Value Investing at Stanlib, is standing by. Sean, thank you so much. Let's take a look at Group 5. A slight dip in revenue to around 11.3 billion rand. Operating profit before adjustments is up around 10%. Your view on this company, given the fact that the construction industry is under pressure. It has been under pressure for some time now. And we also saw those AdCorp numbers out today showing that the biggest slump for the month of July when it comes to employment was in the construction sector.
And that's probably understandable, because we're bearing in mind that construction ground to a halt for the Soccer World Cup. But on these set of results, you know, the earnings number is quite heavily off. I think around about 40-odd%. But I think one must bear in mind there's a lot of once-offs in the numbers. There's an impairment. There's also a loss on property sale. But the plus side, they grew operating margins, and that came on the back of the construction business rather than the construction materials business, which actually suffered. And that will be on the back of timelessly finishing those great projects like the King Shaka Airport and the Durban Stadium. Now, obviously, that's the past, and one has to look forward. So I suppose for us, the question to ask is, what is discounted in the share price? Because we know earnings visibility is poor for the construction companies going forward, but what are the share prices discounting? And that's a question we grapple with.
And it's all about government and pipeline projects, of course. Kevin, your view on this?
Unfortunately, it is. If you look at the private sector, there's honestly not much happening. I'm not aware of any major private sector projects, really, that's about to commence. So it's all about government, and within that, public corporations or the parastatals doing the projects. We know that from a budget point of view, the money's there. If you look at what the Minister of Finance put in the February budget, it was 845 billion over 3 years. So the allocations are there in terms of these infrastructure. What we're picking up, though, is significant delays in a number of these projects actually being approved and implemented. And my worry with some of the construction companies is that while their order books may look fair or reasonable, that you may find in reality those order books take some time to be materialized, and that future projects are a little bit delayed. So I'd be a bit cautious generally. I don't think the sector is that expensive, but it's all about the future order flows that come through.
Taking a look at Aveng, Sean, and I just read some news that Aveng will be paying a fine of around 21.9 million rand following an investigation into anti-competitive practices. Roof bolt division, that's what it's all about, and also the fact that the company came out with some interesting numbers a couple of days ago.
I suppose that's quite right. It's relatively small in the bigger scheme thing of Aveng. But the trading update that came out is I suppose better than what the market expected, expecting a drop of about 5 to 15%, which puts you on a number of about 450 to about 5 rand headline earnings per share. And I suppose a lot of that would have come from the steel trading division, which Trident Steel, which would have benefited from the higher steel price. So again, showing that construction is under a little bit of pressure. And as Kevin quite alluded to, although the order books are there, it's a matter of now turning those orders into work. So I suppose if you want to be in the construction companies, you've got to choose those ones with strong balance sheets. And if you look at Aveng, I think it's got about 23% of its revenues in cash. Got a relatively strong balance sheet, and also they're quite geographically diverse, and I suppose that's exactly where you want to be in the construction sector, with those companies that are geographically diverse and also product diverse as well. So where the current share prices are sort of taking us, they're taking us down to about 2002 levels, and in order to justify that, you need to see about a 50% drop in operating margins. Now, I don't know if that's going to happen, but I do know if you buy the shares at the current price and operating margins do fall by 50%, you're paying fair value. If they fall by less, well, then the market will be pleasantly surprised. If they fall by more, then obviously it's going to be further down.
Sean, isn't it also just about the margins when it comes to the construction sector? Because we've seen margins squeezed for some time now. When do you see a recovery? Because at the end of the day, there's going to be a lot of competition amongst the massive construction companies in South Africa to try and get some of the work that government will be rolling out, because we know it's going to be at a very slow pace.
No, that's exactly it. That's why if you want to buy the companies, you want to buy the ones with the strong balance sheets that have the capital and the patience to see this through if those government spend is delayed for longer. Because we know there needs to be spend in power and water, and maybe in low-cost housing as well. But I suppose, for me, the thing is where can you stomach operating margins falling by? And I think one must forget the super profits that these construction companies made for the 2010 World Cup. I mean, that was a line drawn in the sand. You've got to say to yourself, now going back, and that's why we kind of see operating margins could fall to levels of 2002 and then picking up from there. Most of the companies are saying that 12 to 18 months. Now, the market will obviously look forward, and when they start seeing evidence of that, then they'll obviously re-rate these stocks accordingly.
Sean, very quickly, looking at Bell Equipment, sort of on the periphery of the construction industry, but very much tied in, and a good barometer in terms of what we'll be seeing going forward.
I think when one looks at Bell, they obviously come out of a very tough time. I mean, they've come from a loss now to turning slightly positive. But I think the highlight there is obviously, they had a rights issue, so the cash has come through. They've reduced their debt, they've restructured the balance sheet, and the tax is a lot lower now as well, and the interest line is a lot lower, which falls out the bottom line. But their forward statement is a lot more positive. They're saying they're seeing orders in the yellow metal division. They're seeing they've reduced their inventory as well. So a lot more positive than maybe what other companies are saying, but I suppose it's still early days from that recovery that they've come out of.
Sean, thank you very much for your time this afternoon. That was Sean Stockett from Stanlib. Okay, so with me, Kevin Lings, of course. Kevin, I'd like to quickly touch on some of the top movers and losers on the JSE All Share. Just looking at the likes of ArcelorMittal, a company that came out with some interesting news, wanting to buy Imperial Crown Trading, of course. That's stake in Sishen under the spotlight. 800 million rand is what they're looking at this point in time, and we know that ArcelorMittal rallied on the back of this news.
Yeah, I guess it's, cynically you would look and say, what are they buying? I mean, they're spending 800 million and getting what? One isn't quite sure exactly what the underlying is. Obviously, it relates to the mineral rights within Sishen, which they've lost. So it's continues on with the sort of Mittal Kumba battle. I don't know what it tells us about The arbitration process between Mittal and Kumba that we know still has to go ahead. We know they've got an interim arrangement in place in terms of the pricing. But there's still an arbitration process. I don't know whether this purchase means that arbitration process is now on hold. I suspect that the statements will still suggest that they continue on, but they may well review that. So in the end, it's still a messy situation, and we still have to have a resolution to it. I don't think this deal necessarily brings an absolute resolution.
Kevin, Anglo-American down 3%, BHP Billiton a loss of almost 3%, Exxaro down 3%, Richemont down 2%. I mean, taking a look at what's at the bottom of the top 40 is clearly, really resource-based at this point in time. We saw some losses coming through on the commodities picture because we had the dollar gaining ground, a lot of uncertainty coming.
That's right. Yeah, it is a bit of, again, back to that sort of theme of global uncertainty in terms of just the general global recovery, uneasiness about the US story. I think the Fed situation is also feeding into that. Obviously, what the Rand has done, I don't think has really helped that. So we need, what the market needs mostly at the moment is a very clear direction on what's happening with the US economy. I think it's comfortable with the emerging market story, but that's in the price. There's nothing new that's going to emerge suddenly around China or India, etc. So we're comfortable that emerging markets are doing well, they'll outperform. We're kind of comfortable that Europe is really going to struggle, and that's, I would say, is in the price. There are no surprises around that. The thing that the market is struggling with, and it ebbs and flows literally week by week, is the data around the US and how strong and convincing that recovery is, or is it back into a double-dip recession? And as that sentiment changes, so the markets are either gaining or losing ground, and right now there's a little bit of unease, and it'll probably be reflected in the Fed statement. So if the Fed comes out tonight and suggests no, everything on track, you'll probably see the markets rally tomorrow, but my suspicion is the Fed will play this fairly cautious and indicate that things are fairly soft.